right, welcome everyone to another episode of Conversations with Curio, where we get really curious about different financial topics. And really excited for our conversation today, joined by Monica Elizondo of Longbridge Financial. Really excited to have a conversation with you this morning, Monica. You doing all right?
Yes, I'm doing great. Thank you for having me. I'm excited to be a part of this episode today.
Yeah, well, thank you so much for joining us. And just a little intro on Longbridge and on you, Monica. So Longbridge is one of the top-rated reverse mortgage companies in the country, and they're really one of the go-to companies for fiduciary and fee-only financial advisors looking for home equity solutions for their clients. And Monica, you have a lot of experience and expertise in this area. You have a background in, marketing and customer service and finance. And I think you're licensed to originate loans in 14 states. Is that right?
That just increased this past year. I'm in 25 states. So half the country I can help.
Half the country. That's it, really. That's exciting. So you're really, you're out there. You're based in Charlotte, North Carolina. Is that right?
That's right. I'm on the East Coast, but a lot of my clients are on the West Coast as well. So I'm pretty flexible with my time.
Yeah. Well, half the country, like you said. So there's no better person to have on the show this morning to talk about reverse mortgages. And Monica, we had been working together, on a situation for a client, and you'd shared with me a really interesting article out of the New York Times that it really kind of really spurred our interest in kind of wanting to unpack reverse mortgages further. There's an article in the New York Times in April of, I think, 2022, and the title of the article was "Reverse Mortgages Are No Longer Just for Homeowners Short on Cash." And the subtitle there was "Turning Your Home Equity into Cash Can Help Pay the Bills, Preserve Savings, and Other Investments. They're complicated and not for everyone." And like any good New York Times article, they really, did their research and got into the weeds on this subject to really unpack it. And that's the idea for this morning. Let's unpack reverse mortgages a little bit. And we want to learn what we can from you on this subject. And I guess there's probably no better place to begin than just kind of that high level overview. Can you tell us what home equity is?
Absolutely. So simply put, home equity is the market value of your home minus any liens on your house. So a mortgage is a lien. Just to give you an idea, if you think your home value might be $200,000 and your mortgage is $50,000, your equity is $150,000. And this can fluctuate. How much equity you have in the house fluctuates over time with the market as your home value appreciates, but also as your mortgage balance goes down. So the way to initially acquire equity is by that down payment. If you're a new homeowner, that's going to be the first way for you to acquire that equity.
Mm-hmm. And, as we kind of think about the idea of home equity, I mean, how do you see it changing over time? I mean, just kind of broad brush, if you're younger, getting into the housing market versus in retirement, who has more home equity typically?
Always going to be somebody in retirement. They more than likely have had decades to build that equity in their home over time. Most people in retirement don't have liens on their homes or mortgages. That's not always the case, but ideally, if entering retirement without a mortgage payment, it is great if you're able to do that. Newer homeowners, they're more than likely going to have more debt, so less equity in the house.
Yeah. You mentioned something that kind of piqued my interest a little bit. A lot of folks are, entering into retirement. They don't have a mortgage on their house anymore. And I would imagine you've had a lot of good conversations with folks over the years. They've worked really hard to put themselves in that position where they feel free from having a mortgage. It was an important financial goal for them. How did that kind of mindset, for folks entering into retirement with no mortgage, did it change? And, do folks get to a point where they, say, okay, you know what, I've got all this equity in my home. How do I use it?
So There's usually two camps of people that I speak with, and
Mhm.
all of my clients are 62 and older, so most of them are in retirement.
Mhm.
And it's usually the first camp is people who are very against adding a mortgage to the house in
Mhm.
retirement because, like you said, they've worked so hard for it to be free and clear, for them not to have any outstanding debts on the home. That's ideal for them.
Mhm.
We also have another camp who sees the house as their largest asset, and they're more comfortable or willing to tap into that equity, even though it means potentially adding debt
Mhm.
in retirement. And there's pros and cons to both, obviously.
Mhm.
So it just depends on what your goals are, where you are financially. Some people do need to tap into equity in retirement for emergency reasons.
Mhm.
Hopefully, not for, that's not the case for a lot of people.
Yeah. Well, I think that's, I don't know, at least, when I came into, this industry, I don't want to say reverse mortgages were, a kind of a dirty word or a bad term, but they definitely, it comes with baggage, right? And like, I think there's this kind of notion that a reverse mortgage is an option of last resort, and that the only situation in which it could fit is one where it's the only asset someone has. There's really no other options for them, and they want to stay in their house. But you just described, this kind of much more nuanced approach to looking at a reverse mortgage. Really, is it's a financial tool, and it's a shoe. Does the shoe fit for the situation and for the client's goals and their other mix of assets and so forth? Um, what are the kind of the most common situations where you see folks getting interested in a reverse mortgage?
So people dive into the reverse mortgage for a plethora of reasons, honestly, but a lot of the times I see people coming to me wanting to eliminate their mortgage payment. So
Mm-hmm.
whether it's a large balance or a small balance, a lot of people just want to get rid of that and eliminate
Mm-hmm.
it.
Okay.
So a reverse mortgage is considered a refinance.
Mm-hmm.
You would, in that situation, we're paying off their current mortgage, and their new loan is the reverse mortgage, which they
Mm-hmm.
don't have to make any payments on.
Okay.
They're still required to continue paying their property taxes and their homeowner's insurance, but no mortgage payment ever required. So it should free up a lot of cash flow in
Mm-hmm.
retirement.
Mm-hmm.
That balance is only going to be due when the borrower moves out of the house or the last remaining borrower passes away.
Mm-hmm.
So you are able to tap into your equity without payments in retirement, which is significant for a lot of folks.
Mm-hmm.
Most people are on fixed income, Social Security, maybe a small pension, and we're starting to see less and less pensions over time.
Yeah.
And so financially, a lot of people are tight. That's not the ideal situation, but it's common and it does happen. So
Mm-hmm.
tapping into your equity without payments is going to be huge. But more importantly, the reverse mortgage allows you to open up a line of credit. And any money that you put into the line of credit isn't borrowed and it's growing over time for you. So you can essentially use it as an emergency cushion for your retirement and let it grow until you need to access it. So I would say the earlier in retirement that you get a reverse mortgage and open up that line of credit,
Mm-hmm.
the better off you are. It's really securitizing your retirement.
So I mean, I kind of feel like I should have asked you what a reverse mortgage is to begin with, but you really began to describe it there. I mean, reverse is in the name. I mean, it really sounds in a lot of ways, it's kind of the opposite of a traditional mortgage, right? I mean, you're able to tap into your equity in your home without a payment. And,
Yep.
you'd mentioned line of credit. I think typically a lot of folks think of, say, a home equity line of credit. Can you just kind of point out again those differences between, say, a home equity line of credit and the line of credit that you're describing coming out of a reverse mortgage?
Definitely. So a home equity line of credit, otherwise known as a HELOC, is one way to tap into your equity. Obviously, those are going to have your regular required monthly payments.
Mm-hmm.
Those are normally adjustable payments. Uh, And a lot of the times, the first 10 years of your HELOC are interest only payments, but it allows you to access your equity and use it however you'd like. The difference between that and a reverse mortgage line of credit is the payments. So there's no payments required. Plus, it's growing your money for you. A lot of people think they're earning interest on the line of credit. That's not what it is. What the line of credit with the reverse mortgage is doing is it's increasing your accessibility to your equity over time, which is huge. And keep in mind, your equity is tax-free money because it's not considered income. So for a lot of retirees, that can be pretty significant.
Do you see many instances where folks are really looking to a reverse mortgage, opening it up, getting this line of credit established, really as a tax strategy?
Yes. Or
a tax first strategy?
Yes, it can be that. What I will say is the reverse mortgage is not going to provide tax relief at the end of the year or when you're doing your tax returns unless you make payments on your loan balance. That those interest payments are what you get back when you do your tax return, but more than likely, you're not going to be making payments on the reverse mortgage. So there, you won't get those tax benefits in that way. Now, whenever your heirs or if you move out of the house and you pay back the balance yourself, then at that point, that's when you can get tax benefits when you pay back the loan. And again, the loan is only due when you move out of the house or the last remaining borrower passes away.
Okay. And I think, that article that you sent over, they cited some really interesting research kind of looking at, kind of use case for reverse mortgage and looking at the tax perspective in particular and kind of running a couple of different scenarios, for someone in retirement, taking distributions, say from a portfolio of some pre-tax accounts like an IRA or 401k, and really using that versus a blended strategy where someone's able to open up a reverse mortgage and kind of control their tax situation more and on an ongoing basis, kind of blending income, tapping into the reverse mortgage while also taking distributions from their portfolio. The end result was that, kind of that terminal portfolio value, the estate value was greater on an after-tax basis.
Right. You should be preserving your portfolio by opening up a reverse mortgage. Since the funds are not taxable, it should expand the longevity of any other retirement assets that you may have, which are taxable. So yes, if you use it as a buffer asset, it should expand your portfolio. You normally see a bigger legacy left behind by doing so. And it's always beneficial to include your financial advisor maybe to help you know when to tap into your equity at the right time. If your portfolio isn't performing well, maybe that's the right time to use your equity.
Yeah, no, nice plug for us advisors, because that's definitely, an important part of what we do. We're staying a few steps ahead, looking at, a client's cash needs, not only in the current year, but in the, years to come. And, taking a look at, especially from the tax perspective, what could make the most sense in terms of distributions. And then importantly, like you mentioned, sometimes, we encounter headwinds in markets and the portfolio is going through a sequence of poor returns. That sequence of poor returns could correspond to a moment in time where our client actually needs more money from the portfolio than usual.
Yes.
So, the reverse mortgage, like you're describing, can really step in and help kind of shield the portfolio during that period of time from that sequence of poor returns.
That's right. And your home is likely your biggest asset. So you're just using a portion of that equity. It's not all of it. There's a lot of misconceptions that you're not going to leave anything behind to your heirs. All of the equity will be used up. That's not necessarily the case. What'll happen is you're going to use a portion of it for your retirement, and you're still going to leave a significant amount to your heirs. So you're really just living more comfortably in retirement by doing so.
Well, there's a nice segue into what something I really wanted to touch on, which were some of those misconceptions that you talked about. And um, you mentioned a couple, so kind of not having any equity left over, not leaving anything to your heirs. What are some other, misconceptions that you hear, about reverse mortgages? Some myths, so to speak, about reverse mortgages that are out there.
There, there's a lot of misconceptions, unfortunately, but that's why we do these
Yeah.
podcasts. So the biggest one that I hear is definitely, so you're taking over my house, right?
Mm.
And I have to clarify, nope, nothing changes with the title. You remain the owner of your house. We are just your lender,
Mhm.
just like your current mortgage now.
Yeah.
When the loan becomes due, we only ask for the loan balance to be paid back. If there's money left in the line of credit, which again is unused, unborrowed money,
Mhm.
it's going to remain as equity in the home. So it's only the balance that gets paid back. And borrowers or clients have a lot of control over their balance. Just take the money as you need. So you have flexibility over that balance. And again, still a lot of equity left over in the house. So their heirs, or if they move out of the house, they keep that equity. It's for them to keep.
Mhm. I think, yeah, also, you're talking, I'm just thinking, at least one of the misconceptions that I had, early on was that reverse mortgages, it's a really, there aren't a lot of options. You open a reverse mortgage and then you just kind of flip the cash flow and you just start getting monthly payments. But this idea of a line of credit, something that you can tap into and really create a lot of flexibility, it sounds like that's really how you're seeing a lot of reverse mortgages being used.
Yes, yes. By far, what I see most commonly done is my clients will take a lump sum of whatever they need immediately. So whether it's home improvements or consolidating debt, home health care, whatever it is they need right now, they'll take as a lump sum. And whatever they don't need right away, they'll leave in the line of credit unborrowed.
Mhm.
And like I mentioned earlier, the money grows. Right now, the growth rate is around 7.5%, almost 8% for some folks.
Mhm.
And that's compounding every month.
Mhm.
So if you have $100,000 in the line of credit, you can see how that growth can be quite significant over time.
Mhm.
And so just let it grow and take the money as you need.
Mhm.
You certainly have the option of taking monthly payments, like you mentioned, or a combination. You could
Mhm.
do either
Okay. Yeah.
a lump sum, monthly payments, or a line of credit, or
Okay.
a combination. So there's a lot of flexibility with this loan, which is
Yeah.
great.
Flexibility. I mean, that's in so many ways such an important aspect to financial decisions, and it's, reverse mortgage has a lot of that flexibility. Um, as you're talking about, kind of opening up the line of credit or kind of establishing, how do you determine how much equity, someone can tap into? What are some of the factors influencing that?
Great question. So there's three factors that determine how much equity you qualify for. And the first is the youngest person's age. So usually it's a married couple. So out of the two of them, whoever's younger,
Mhm.
the home value and the current interest rates. Those are the three factors that determine what we call the principal limit, how much you qualify for. And that does change weekly because of the interest rates. As you know, right now, we're seeing higher interest rates than we've seen in a long time.
Yeah.
So because of that, as the rates go up, your principal limit goes down. You're
Okay.
qualifying for less money when that
Mhm.
happens. Luckily, as you know, we're expecting the rates to come down eventually. And as that happens, clients are automatically qualifying for more money.
Okay. And is that they're automatically qualifying if they're applying for a new mortgage, or if they have an existing line of credit that's influencing the amount of the principal limit on the line of credit that they have?
Yep, exactly.
Okay.
So they're going to qualify for a certain amount,
Mhm.
and it's up to them how they disperse that money. If they
Okay.
only want to put 50,000 in the line of credit and receive the rest as a lump sum, they can. The way they structure it is up to them.
Okay.
I always try to suggest to my clients, try to leave whatever you don't need in the line of credit. It's hard for me to tell my clients what they need and what they don't need, but I do try to encourage that growth on the line of credit because it's so significant.
Yeah, I mean, you have that expertise and familiarity, kind of knowing, okay, what's really going to make the most sense. And everybody's situation is different. You don't always have the kind of benefit of knowing someone's situation in a lot of detail, but I think that's really where an advisor working with their client and working with you and your expertise in this area, as a team effort, can really find a solution that's the right fit.
Exactly.
I did one thing where, oh yeah, go ahead.
I was just going to say, because the financial advisor has a greater financial picture, so they have an idea of where the money, or they have a plan for the future, as opposed to me, the lender, who I have a smaller idea of what's happening with their finances. So I always, if there's a financial advisor in the picture, that's the most ideal situation.
Yeah, because it's really, and the equity, like you said, I mean, it's the equity that folks have in their home. It's in a lot of cases their single largest asset on their balance sheet, but it's not the only asset. So, their situation, everyone's situation is always more complex and nuanced than just the equity they have in their home. So, kind of putting all the pieces of the puzzle together is important. One of those puzzle pieces that we focus on, as we work with clients around any set of decisions, are the risks associated with the decision. I mean, as you work with folks, what kind of risks are you pointing out around the reverse mortgage? The one that comes to mind is, the value of the home going down. How does that impact the reverse mortgage? But can you kind of shed some light on any risks that, folks are taking on with a reverse mortgage?
Sure. So yeah, it's just like a mortgage in the sense that you are putting a lien on your house and you're using your house as collateral, right? So you want to make sure that you're still paying your property taxes and your homeowner's insurance on time. That's the one thing that can get you in trouble, is if you don't pay those on time. Yeah. We'll always bend over backwards, though, to put you on a payment plan or help you and make sure that you're back on track. I would say there's also two scenarios in which the reverse mortgage might not be a great fit for somebody. And the first is if they are planning on moving out of the house in the next year or two because of the cost. The reverse mortgage is a little bit more costly than a regular conventional mortgage. So the longer you have the reverse mortgage, the more years the cost is spread over. So the longer, the better. And the second is if that client is trying to leave 100% of their equity to their children. If they want to do that, then the reverse mortgage is not going to be the best fit for them. But if they do want to use a portion of their equity and still leave a significant amount for their heirs, I do think it would be a good fit for them. Trying to think, the only another risk. Trying to think. There are really no other risks. There's no mortgage payment required. As long as you pay your taxes and your insurance, the loan will only be due when you move out or pass away, and you have control over that balance. So a great fit for most people.
So, I think you talked about the principal limit, and I imagine that's one of the guardrails, against, what if the value of the property goes down between the time when you establish the reverse mortgage and the time you sell the house, and you've taken out, your loan balance is essentially more than what the property's worth. Is that situation common? Is that, what do you do in that situation?
I'm glad you brought that up. So these reverse mortgages are FHA insured. So the Federal Housing Administration insures every reverse mortgage on the market, unless it's a private reverse mortgage, which we do have at Longbridge, but they're homes above $1 million. They're jumbo loans. So really, for most people, it's going to be an FHA insured reverse mortgage. And this insurance that borrowers have to pay into, which it's 2% of the home value, this insurance is going to protect them and their heirs from ever paying back more than what the house is worth. So there's never going to be a point in time where they ever have to worry about paying more than the home value if they go upside down on the loan. So what you're describing, if the balance exceeds the value of the house, they don't have to worry about it. The FHA insurance kicks in, and they're only responsible for paying back what their house is worth at that time. And the FHA pays the difference above it. So there's a lot of peace of mind knowing that the insurance is going to cover them if they go upside down, but it's not common for that to happen.
Okay. And so that FHA, protection is really an important aspect. You mentioned the private, reverse mortgage products, but really for most folks, if they're not in that kind of jumbo, territory, using an FHA insured product is really the safest way to go.
It's considered the gold standard in our industry.
Okay. I gotta ask, what's the difference between a reverse mortgage and a home equity conversion mortgage? Are they one and the same, or what are we talking about here? Because that HECM term we come across, and are there any differences between? Are they talking about them interchangeably, or are they different?
I'm glad you asked. No, they're the exact same product. Okay. We call them HECMs, home equity conversion mortgage, otherwise known as a reverse mortgage.
Okay. All right. So one and the same. And, the HECM, it's, like I said, the term reverse mortgage seems to come with some baggage. And, but yeah, I mean, the home equity conversion mortgage, it really sounds much more clinical and much more similar to, it's what it is, right? So,
right. It's what it is. You're right. I think that they call them, home equity conversion mortgages in Europe. Ironically, in the US, we only use that demographic, 62 and up. We only use reverse mortgages within about 3% of our homeowners. And if you go to Europe and you look there, it's higher than 30% of their seniors use reverse mortgages. Yeah. So we need to overcome these misconceptions because it's a great retirement tool.
That's a really interesting statistic. And I mean, like you said, I think probably speaks to the misconceptions and really, I mean, what we've been talking about today, I mean, it's really, this is a tool that can create a lot of flexibility, not only in terms of distributions from your portfolio, but, you have kind of this tax advantage, taking money out, tapping into home equity is tax-free. So not only kind of navigating volatility in markets, but navigating, different tax situations and so forth. And I heard you say a couple of times kind of getting it open sooner, the sooner the better, sounds like.
There's a lot of research studies to show the sooner that you get a reverse mortgage, the better off you are in retirement. You're going to have a greater monthly cash flow. You're more than likely going to see your other assets grow, like you were saying, in your portfolio, because you're not touching those quite as quickly. So you're going to leave more than likely a higher legacy, a bigger legacy to your kids by opening up the reverse mortgage and utilizing it well, managing it. You can kind of also think of it like a credit card, that line of credit. So you can tap into your equity, all at once early. So I would recommend trying to spread out that equity that you're qualifying for and making sure that you don't outlive all of your retirement assets. So it is a balancing act.
Yeah, I think that's definitely a fear for a lot of folks is, they're looking at, their value, just their portfolio, their financial assets, and really focused on, not outliving that portion of their balance sheet. And then in the back, kind of all of our minds, we have this home equity piece in here that can fit in some way, maybe in the future. But really, I think taking even a few more steps back and saying, let's go ahead and start to think about the equity that you have in your home now, because we don't know in what ways you may need to take advantage of that flexibility in the future. Again, I think kind of speaks to that, the sooner the better, to really enhance the flexibility.
The sooner the better. And most retirees want to age in place. They want to stay in their home, and this is going to be one way of ensuring that happens.
Yeah, no doubt about it. I mean, we see those numbers, usually 75 to 80% of folks, if they're asked, they want to stay in their house as long as they can and age in place. And the options for doing that can really become limited. Your ability to do that can become limited if you've depleted or started to really draw down your other assets.
That's right. Exactly. So it's a good thing to think about it early in your retirement.
Yeah. Well, we've covered a lot of ground here. Is there anything else that we didn't cover that you really wanted to point out, around reverse mortgages or misconceptions?
Um, no, just other than that, most people who are 62 and up have enough equity in their house and are homeowners could benefit from this product. We're seeing a rise in senior poverty right now, and it's a lot easier to qualify for this reverse mortgage. We don't even look at your credit score than it is like a conventional mortgage. So I would say for most people, it's a good fit, and I'm glad that you took the time to cover it.
Yeah. Well, thanks again for joining. This has been a great conversation. I learned a lot. Got some, really helpful information to take away with us. And yeah, for any of you out there watching, we'll have Monica's contact information available if you want to get in touch with her as well. And thanks again, Monica. And yeah, thanks everybody for watching. Drop a like or subscribe for more content.
Have a good day. Thank you again.
Thanks.